Okay. Good morning, class.
Good morning, all.
Okay.
Morning, sir.
Yeah, Michael.
Morning, sir.
All right.
Okay. So let's quickly look at this very simple topic. First, I hope you guys are preparing for your exams. Your exams are very close now. Just do whatever you can to ensure you pass. Okay. So let's quickly look at this one. I'll look at it in a very exam-friendly way so that in case it comes out, you do it. So earnings per share is IAS 33 that takes care of this topic, earnings per share. And so majorly, a company that is listed on the stock market is required to state its earnings per share on its statement of profit or loss. On its statement of profit or loss. And this earnings per share, okay, it can either be stated on a single SOPL or a consolidated SOPL. So any company that is listed is required to state its earnings per share on the statement of profit or loss. Either you're a single entity or a group of entities. State your EPS is a requirement of IAS 33, which means that if a company is not listed, that means it's not required. That company is not really required to state EPS on their statement of profit or loss. So how do we determine EPS? Now we're going to be looking at there are two types of EPS we would calculate. Number one is basic earnings per share. Number two is diluted earnings per share. In the next 1 hour, I would take care of the two. The first one, which is basic earnings per share, is usually calculated as a profit after tax minus preference dividend all upon weighted average number of ordinary shares. Okay, this is how you calculate basic earnings, but really it's the same way you calculate diluted as well, but diluted just has some additional details that we need to be aware of, but it's really the same formula. But the very simple one is this: profit after tax minus preference dividend divided by weighted average number of ordinary shares. Okay, so let's look at how to determine each of these items here. If you look at this question, it says Marian Co., a publicly quoted company, has the following transaction during 2016. It says on 4th January 2016, it has shares outstanding at the beginning of the year of 340,000. On 31st March 2016, he issued new shares for cash, 160. Therefore, as at the end of the year, the total number of shares he has is now 500,000. We are now asked to calculate weighted average number of ordinary shares outstanding for 2016. Okay, so that means this denominator here, you need to be able to determine it. It's not just the number of the balance. It's not just picking this number of ordinary shares they have. You need to really determine the weighted average number of ordinary shares. So look at how it is determined. So the way we do it is this. Okay, let me just go straight to the way it works. So the way we do it is the weighted average number of ordinary shares. I can calculate it as this 340,000 shares plus 160,000 shares multiplied by 9/12. So why am I doing this? At the beginning of the year, we have 340,000 shares. That means this 340,000 shares has been there. And in fact, whatever profits we make for the year, they are entitled to it, because as far as this 340,000 shares is concerned, their investment has been around even before 2016. So they are entitled to the full profits for 2016. So whatever EPS you calculate, know that these guys are entitled to a full year profit, because they have been there since the beginning. But you see these ones that we just issued in March, these ones are not entitled to full year profits because they came in at the end of March. They are only entitled to 9 months profits. So in order to determine the number of shares for the denominator of our EPS calculation, you will need to do a time factor. You need to prorate these ones based on the number of months they were there. And that's why we are prorating this guy. So if you punch your calculator, so if you prorate this, what does it come to? 160 times 9/12?
5,000.
Sorry?
It's 120,000. 120,000.
120,000. Then it gives us how much?
460.
Okay, so that's the idea of weighted average number of ordinary shares. It's just prorating the ordinary shares that we issued during the year. Those ones are not entitled to full year profit. They are only entitled to the extent of the number of months they were there. That's one. Two, says Werico has 200,000 ordinary shares of €1 each and 60,000 10% redeemable preference shares of €1 each. Werico has a profit for the year of 400,000. Werico has paid the required preference shares, preference share dividend, and ordinary dividend. Calculate basic earnings per share. Okay. Now, when you are calculating basic EPS, is basically determined as your profit after tax minus your preference dividend divided by weighted average number of ordinary shares. Weighted average number of ordinary shares. Now, how do we determine all of this? Now, my profit after tax, I can see that the number of shares here is 200 ordinary shares. And this guy has 60,000 redeemable preference shares, 10% redeemable preference shares of 1 naira each. Rerico has a profit for the year of 400,000. Rerico has paid the required preference dividend. So, if I'm calculating my EPS, what's my profit after tax or profit for the year? I'm told is how much? 400,000. Now, what is my preference dividend? No doubt, my preference dividend is 10% multiplied by 6,000. But if you go and do minus 6,000 here, you are going to be wrong. You will be very wrong because this 6,000 in this case is already been deducted. It has been deducted before arriving at this profit. It has already been deducted before arriving at this profit. Is there anybody in this class that can justify that for me? That can look at why I'm saying that this preference dividend has been deducted before arriving at this 400,000. Is there anyone in this?
Let me give it a try.
Okay,
On the
Femi.
last,
Okay. I
the
think
last
redeemable preference share, I think is a debt instrument, and you are supposed to pay interest on it. So before
Sir,
you arrive at the profit for the year, you would have deducted the interest from the profit to arrive at the net profit. So you don't need to deduct it again. That's my own view.
Okay. Nice one, Femi. Is there any other opinion?
sir, in my own opinion, sir, I think the question says Perico has paid the required preference share dividend and ordinary dividend. So, according to the question, it has been paid, sir.
Okay, that's why we should not deduct it. Okay. Any other opinion? Let me take one more opinion.
Okay, sir, I want to try.
Okay.
So
take a look.
I think based on like our statement of financial position under our under our like equities, we have like retained earnings and dividend. Our dividend would have been like deducted to arrive at like our profit for the year, and based on that, also in our equities, our retained earnings, dividend and all those things would have been deducted for us to have our profit for the year. That's my own view.
All right. Thank you very much. So Femi is correct. Femi is absolutely correct. Yeah, is absolutely correct. And that's the reason. He said that this preference shares is a redeemable preference shares. We taught you this when we were teaching you financial instruments, that preference shares can either be equity or debt. If it's redeemable means that they will collect, we are supposed to pay them back. That means it's debt. We have an obligation to deliver cash to them. So it's debt, it's a debt instrument. And any interest you pay on debt should be treated as a finance cost, which is what Femi said. So, and that finance cost will have been deducted in P&L before getting to profit for the year. So the preference dividend in this case that they are referring to here is the one where preference shares is regarded as an equity, where it is an irredeemable preference shares. So where it is an irredeemable preference shares, in such cases, the dividend will pay to them is you won't find it in P&L. Just like you will not find dividend paid to ordinary shares in P&L. You put them directly to equity as a deduction from equity, from retained earnings in equity, in your statement of changes in equity. So those are the dividend you come here to remove, just so that the EPS we want to calculate here is the profit belonging to only ordinary shareholders, not all equity, but only ordinary shareholders. So for this 6,000, like Femi rightly said, it has already been deducted because this preference shares is debt. And any interest you pay to debt, to a debt instrument, is a finance cost, which will be treated in P&L already. So kudos to you, Femi. Yeah, can see you're very hot right now. So 400,000 profit divided by 200 ordinary shares. How much does that give us? That's 200.
Sure.
Supposed to be 2 naira, but we usually express EPS in kobo. We usually express EPS in kobo. So we're going to leave it this way. Next question.
But sir, when I divided it, it's 2 I was having.
2 naira now. So change it to kobo, 200 kobo.
Yeah, divide by 100. 2 divided by 100.
Yeah. So if you do 400 naira divided by 2, you have 2 naira. Okay. But we don't usually express EPS in kobo. So 200 kobo.
Okay, sir.
Yeah. Okay. You can ask your questions now, please.
Mr. Wasiu, I just wanted to confirm. So if it was like an irredeemable preference share, that 6,000 would have been deducted from the profit after tax, right?
Yes.
Okay. All right.
Because they wouldn't have deducted that one yet.
Okay. All right. Thank you.
Yeah. Are there any other questions?
Yes, sir. Good morning.
Good
My
morning.
question is, if in this question, if they didn't tell us that the redeemable preference share has been deducted, are we supposed to know that, or will we deduct it if they
didn't
didn't
tell us.
say Werico has paid the
This one does not even matter. Whether they have paid it or not is irrelevant.
Okay.
It's irrelevant because even if they have not paid it, we'll accrue for it. We'll still put it in our books.
Okay.
Yeah. Another one says Werico has 200,000 shares of 1 naira each and 60,000 10% irredeemable preference shares of 1 naira each. Werico has a profit for the year of 400,000. Werico has paid the required preference dividend and ordinary dividend. The tax rate is 30%. Calculate the basic earnings per share. So basic EPS is profit after tax or profit for the year minus preference dividend divided by what?
Weighted
Weighted
average
average number of what?
ordinary shares.
Ordinary shares. What's the profit for the year?
400,000.
400,000. In this case, are we
No,
going to
sir, it's not 400,000.
Baby.
In this case, the profit for the year will be 30%, deduct it from 400. So it
100,000.
will arrive at profit after tax before you now deduct
But they said
the
they said profit
10%.
for the
No,
year now.
is the irredeemable share that
No,
the tax will be
you
applied
have to
on.
deduct. No, you have
The
to
tax
deduct
are
the
not
tax. You have to
and
deduct the tax. Then you
the
now, before you now arrive at the profit after tax, then you now deduct the 10%. I think so.
Me, based on how you treat that. Okay,
yes, I think you
irredeemable.
deduct because the formula said profit after tax, so we deduct our tax first.
Yeah.
So why are you assuming that profit for the year is profit before tax?
Abi.
We are giving the tax rates.
Yeah.
No.
Okay.
You
Yes,
okay?
for them to have
You need to
that
know
means
that profit for the year is the same thing as profit after tax.
Oh, okay.
Exactly. So that will be applied to the irredeemable preference share only.
Who is buying chicken?
Okay. So, as I was saying, profit for the year is the same thing as profits after tax. It's the same. So you don't have to be deducting dividend again. You don't need to be deducting tax again. Okay. So our profit after tax is 400,000. Now we are going to deduct this preference dividend because it hasn't been deducted because this is an irredeemable preference shares. These are irredeemable preference shares. So let's determine the preference dividend. And the preference dividend is 10% times 60,000, which is 6,000. Then we'll deduct the tax, which is at 30%. That's 1,800. We'll be left with the after-tax preference dividend, which is 4,200, divided by the weighted average number of shares, which is 200,000. So what's our EPS? What's our EPS?
1 naira,
1
98
naira
kobo.
979. 1.979, sha.
1.979.
198 kobo.
198 kobo.
Okay.
So don't forget to always express your EPS in kobo, please. Ah,
Mr. Wasiu, please can I ask a question?
Please go ahead and ask a question.
Okay, sir. So I just wanted to confirm if it was a redeemable preference share, are we going to be giving tax rates? And if we're given, are we going to do that 30% on that on 60% and deduct it from the profit after tax? Or we don't? If it was a redeemable,
No,
does it
no,
come
no.
with tax?
No, no, no. We are not even going to touch that. Just like we
Okay.
did not. They give us tax here too.
No, they don't.
They will have done all of that.
Okay, all right.
So you won't touch it at all because it has already been deducted.
Okay, thank you.
Yeah. Now let's look at this. This says Element Co made an issue at full market price of 2 million ordinary shares on 31st October 2016. The following information for 2015 and 2016 is as follows. Required, calculate the EPS for 2016 and corresponding 2015 for the year ended 31st December. So they want us to do EPS for 2016 and 2015. And from here, he made an issue at full market price of 2 million shares in October. So they give us following information. As at the beginning of 2015, it was this, 2016, beginning of 2016, it was this. Okay. So again, my basic EPS is profits after tax minus preference dividend divided by what? Weighted average number of ordinary shares. So let's do 2015 first. What was the profit for the year in 2015?
1.5 million.
1.5 million.
There was no preference dividend, but what is the weighted average number of shares in 2015?
4.5. Abi?
Yeah, that's
No.
correct.
Okay. Eh?
That's
Nine.
correct. 4.5 million. So how much?
Three is 333
33 kobo.
kobo. 333 kobo.
33 kobo, sir.
Is it 33 or 333?
It's
333.
0.3334.
Just multiply that by 100.
100.
That's
33.
3.3.
It's 33.3.
Sir, is the 33 kobo, sir.
33 kobo. So in 2016, what was my profit after tax?
1,780,000.
What was the weighted average number of ordinary shares?
Don't take off.
4.5. 4.5.
That would be 4.5 plus the issued 2 million shares in October.
Okay.
Right?
Yes.
2 million times what?
Two.
Three
That'd be
over
3
12.
2 over
over
12.
Divided by 12.
Yeah.
October.
So
Is it
October.
what of
October
October?
31st.
Okay.
It's
So 2
2
over
over
12,
12.
sir. 2 over
Yeah.
12.
October 31st. Okay. November, December.
Yeah. They issued it in ending of October, so November, December.
Lie down. Lie down.
So what's the weighted now?
500. 5 million.
5 million.
Yeah. It's not 5 million.
No.
4.83333. Sir, you are correct.
Okay, so how much is our EPS?
36.
36.837.
37 kobo. 37 kobo.
37 kobo. So EPS is not more than this. So now let's go to where there is bonus and right issue. Let's use a question to explain that. So they said impact co. Okay. Yeah, sorry, I'm back.
Yes, please, sir. Hello, sir.
Yeah, I'm with you.
Please, in regards to that weighted average number of ordinary share for 2016. Sorry, I didn't get that.
This one, Abi?
Yes, sir. So, okay, it's 2 all over 3. All right, thank you.
It's 2 over 12.
Thought it was October, November, and December. Where is it? Okay, 31st. Okay, that means start counting from November. All right, thank you.
Yeah. So now this is Impact Co had 800 shares in issue until on 31st October 2016. It made a bonus issue of 300,000 shares. The following information are available for 2016 and 2015. So they give us profit for the year and also EPS. We are now required to calculate EPS for 2016 and corresponding figure for 2015. Now, the thing here is this company had 800 shares in issue until 31st October, where he made a bonus issue of 300,000 shares. Now, we're asked to calculate the EPS. Now, they already did the EPS of 2015, right? So that means the only EPS we need to do is that of 2016, and my basic EPS is profits after tax minus preference dividend divided by weighted average number of ordinary shares. So what's my profit for the year is 160,000. No preference dividend. So what's my weighted average number of shares? I have 800 shares. Abi? Then they issued a bonus of 300. This would be times what?
2/12.
All right. Okay. So now that's just the thing about bonus. You don't prorate bonus. You don't prorate bonus. And the logic is this, when we issue the bonus of 300,000, they did not pay for it. Bonus issue is free. They did not pay for it. So technically, the essence of prorating is just for us to know the portion of the shares that is entitled to this profit. But these guys did not pay. So don't bother prorating. All of them are automatically entitled because we are giving it to existing shareholders. They are automatically entitled to the profit for the whole year. It's a bonus issue. It's a bonus issue. So do not prorate bonus. That's just That's it around bonus. So 160,000 divided by, what was it, 100 plus 300?
1,100,000.
And that gives us how much?
14, 15 kobo.
15 kobo.
Now,
15.
okay.
Yes.
So that means 2016 EPS is 15. 2015 also is actually 20. However, we cannot compare this EPS with this 2015 EPS because 2016 has been disadvantaged in the sense that we added a bonus to the denominator, which made this EPS lower. If we hadn't had this denominator, this 300, this would have been higher. So to a large extent, this EPS has been suppressed because of this bonus. So in order to make the 2 years comparable, anytime there is a bonus, anytime you have a bonus issue, you have to recalculate the basic EPS of the immediately preceding period. You have to recalculate it. Okay, so that means we need to recalculate the basic EPS of 2015, but just so that they will know that it's a recalculation, just call it adjusted basic EPS. We call it adjusted because we are adjusting it. And I will show you 2 ways of doing that. You can do 20 kobo times I want to bring it to a base of 11. So because it was calculated based on 800,000 shares before. That was the number of shares we had in Asia. They will have used that to compute this. But I want to put it to a base of 1.1. I mean, that will include the bonus. So it's 800. I'll just do 800 divided by 1.1. So what does that give us?
$72 kobo.
Laye.
Did you multiply by 20,000? Are we multiplying by 20,000?
Sir, it is
It's
15
0.2
It's
now, not 20.
14 kobo
It's 15
kobo.
kobo.
So
It's
or
15
15
15
kobo.
kobo.
kobo, sir.
15 kobo.
Approximately 15 kobo, yes.
It's 15 kobo, sir.
All right. So that gives us 15 kobo. I hope everybody can calculate this. Just write the figure as they are. It should give you your figure. 800 divided by 1.1 multiplied by 20 gives me 14.5. So that's 15 kobo. Or you can even decide to do this that way. So that's the thing about bonus. Because if you are putting bonus in 2016, and it's not like they brought in money, it's not like you are putting it there because they actually paid for the shares. It's free, which will have suppressed the EPS of that year. You need to recalculate the EPS of the previous year as well, right? By including the bonus. So another way of calculating it, in case you are not given the EPS like this, because they might not give you EPS, they might give you profits. So you can do, what's the EPS calculated? It's 20 kobo, abi? 20 kobo equals your profit after tax over, it was calculated based on 800,000 over 800,000 shares. So if I cross multiply, I can get my my profit after tax. So what's my profit
160.
after tax? 160,000.
160.
Yeah. So I can then calculate my adjusted EPS now. So my adjusted EPS is 160,000 divided by 1.1 million. So how much is that?
15 kobo.
How much? Should give us the same thing now.
15 kobo.
15 kobo.
Yeah. So that's the idea behind bonus. I hope you remember it. So it's just for you to not prorate the bonus. You're not prorating it. And you need to recalculate the previous year's EPS as well. This one says Lamenco has 200,000 shares in issue. It made a 1-for-4 rights issue at the price of 4 naira per share. The market price before the rights issue is made is 4 naira 60 kobo. Calculate the theoretical ex-right price. Okay, now this one I'm preparing you for rights issue. So the thing is that when you issue a rights issue, how do I put this to you? So when you issue a rights issue, your share price of companies usually fall to a level called TEP, theoretical ex-right price. So like in this case now, the company's share price, market price is 4 naira 60 kobo, but they issue the right at 4 naira. So it gives a perception that the company is undervaluing its shares. So it actually it will come down. It's actually going to come down. The share price of the company will fall from this 4.60 kobo to a new price. And that new price is the theoretical ex-right price. So anytime there is a TEP, you would usually need this. Anytime there's a right issue, you usually need this theoretical ex-right. So let's leave it at that for now. So this theoretical ex-right price, there are different ways of calculating it, but the way I do it is in this case we are making a right issue of 1 for every 4 shares that you have. 1 for 4 right issue. So 1 for 4. So this we are saying we are going to give you 1. Our 1 shares that we issue ordinarily at we are giving you 1 shares at 4 naira. Okay, we're giving you 1 shares at 4 naira. Yeah, we're giving you 1 shares that we ordinarily sell at 4 naira for every 4 you have. For every 4 existing shares you have. Okay, and we're giving you that at 4 naira 60 kobo. So all those do is I'll multiply 1 times 4, and I'll also multiply 4 times 4.6. What's 4 times 4.6?
18.4.
18.4. So I'll sum this together and this together.
22.4.
So I'll do 1 plus 4. This is 5. And this is, you said 22 point what?
4. You are correct.
So my TEP is, I'll just do 22.4 divided by 5. And how much is that?
4 naira 48 kobo.
4.48. Now, so this is how I usually think about it. I say that 1 for 4. This 1 for 4, they could present it in any way. It could be 2 for 3. It could be whatever it is. So the meaning is that I'm giving you 1 shares for every 4 shares that you have. I'm giving you 1 shares for every 4 that you have. So, and I'm giving you those 1 shares at 4 naira. For every 4 shares that you have, whose market value is 4 naira 60 kobo. I just multiply these two. I also multiply these two. So I do 1 plus 4 and I add these two. Then I get my theoretical X-right price. So look at it very well. It may be useful. Okay, Mano, can see your hand.
Morning, sir.
Morning.
Yes, sir. Just a curious question regarding this rights issue. Logically, why do companies do a rights issue in circumstances like this, like trying to give 1 share for every 4 that you have? Is it to encourage more purchase of the company's shares or what?
So there are instances where a company needs to raise money, but they don't want to raise money from new investors. They want to raise money from existing investors and they need the money urgently. So they will just issue their existing shares or they will issue new shares at a discounted price. So, and that process is right issue. Okay? That
Thank
process
you,
is
sir.
right issue. Yeah. So, and another thing is that they might want to just compensate their shareholders by issuing shares at a lower price to them, just to compensate them. Sometimes it could be a form of dividend, but I mean, if they want to do dividend and they don't have money, they go with bonus. But right, they also need money, but they just want to collect it from existing shares instead of going out. So majorly that. Okay. So let's then apply this. Let's apply this. So this one, it says Goan could add 250,000 shares in issue. On 1st September 2016, it makes a right issue of 1 for 4 at the price of 1 naira. The market price before the right issue is 1 naira 60 kobo. The profit for the year 2016 is 200,000. 2015 is 145,000 required. Calculate the EPS for the year ended 31st December 2016 and the corresponding figure for 2015. So how do you determine the EPS for 2016 and 2015? Now, this company has 250,000 shares, but in September, they issued a right. So the market price before the right is 160 kobo. The profit for the year are there. Okay, so how do we do our computations? Now, let's start with, I can start with any year, right? I can start with any year, but let me start with 2016. You'll see why very soon. So my EPS, as you know it, is PAT minus preference dividend divided by weighted average number of ordinary shares. So what's my profit after tax in 2016 is 200,000, right? No preference dividend. But what's my weighted average number of shares? That would be 250,000 plus there was a rights issue, right? So that was issued in September. So I need to calculate the rights issue. The rights issue is 1 for every 4 you have. And that's 1 times 250, 1 over 4 times 250,000. And what does that give us?
62,500.
Okay, that's 62,500 shares. Now, should we then do 62,500 times what?
Four over 12, sir.
That's September, October, November, December, 4
Oh,
over
wow.
12.
So,
Okay, so if you do it like this, we would be wrong. We'll be wrong. And the reason is that these 62,500 shares is not fully paid for, in the sense that our share price is 1 naira 60 kobo, but for these 62,500 shares, they only paid 1 naira, which means that there is a portion of these 62,500 shares that is bonus. And you know that bonus, we don't prorate. So we need to extract the portion of this 62,500 that is bonus so that we won't prorate it. So I need to determine the bonus elements of the rights issue. And that is where TEP comes in. So we need to determine my TEP, which is the new price which is our market price after we issue shares, after we issue rights. Our market price, we believe, is not going to be 160 kobo anymore. It comes down to the TEP. So let me compute my TEP first. So my TEP, I'm saying I'm issuing 1 for 4. And I'm giving you 1 shares at 1 naira. Abi? Yes. For every 4 shares you have, which I was selling at 1 naira 60 kobo. So 1 times 1 is 1. What's 4 times 1.6 naira? What does that give us?
6.4.
Sorry?
6.4.
6.4. So 1 plus 4 is 5. And 1 naira plus 6.4 naira, that's 7.4. So my TEP is 7.4 divided by 5.
1.48.
1.48.
It's
1.48. You see
148
that?
kobo.
No, it's 1.48. TEP doesn't have to be in kobo.
pay for it.
So you see that these rights, these are market price, it came down to 1.48. That's TEP. It's always between the right price and the share price of the company. Now, let's now determine the bonus elements. And the way we determine the bonus element of the rights issue is we'll do the TEP minus the right price, because we believe that the differential here is the portion that we gave for free. So this is the market price after the bonus, and we give them these shares at €1. So we believe it's like we give them the difference free. The share that is worth €1.48, we give them at €1. So divided by the TEP, theoretical less right price, then you can then multiply it by the right issue. That will give you the bonus element of these shares. So the TEP is €1.48. The right price is €1. The TEP is €1.48 multiplied by the right issue, which is 62,500. So what's the bonus element?
$20,270
20,270 shares.
Shares.
So now, if the bonus element is 20,270 shares, so that means out of the right issue, what's the fully paid share? What's the fully paid share?
42, 220 and 30.
What did you call it? 42 what?
230, 42, 230.
230.
Yeah, that's the fully paid. So now let's now come back to these repairs. Now, this 62,500, we are saying there is a 20,250 there that is bonus. That one you won't correct that. No, is it 2250? You said 2270.
2275, sir. 2275.
275 too. Okay. I mean, this one too will
It's not
change there.
275.
It's not.
It's 2275. Check it well now.
It's 270.
It's 2270.
Okay. All right. So this one you won't correct because it's bonus. But the balance, which is 42,230, that they fully paid for, that we're going to correct from when they issued it, which is for September, October, November, December, 4 months. So 200,000 divided by, can you do this first? How much will this give us?
14,076 or 77.
77.
Okay. So what's my weighted average number of shares then?
70.
230, 284,
284, 347.
What's my basic EPS?
70 kobo.
I hope this is clear because the whole idea around
Okay.
bonus.
Hello, Mr. Good morning,
Yes,
sir.
sir.
Yeah, good morning, Jerry.
It is not clear. Can you please go over not the basic EPS, what you saw for the TEP, the 148 minus 1 over 1.48 times kind of confusing, sir. Thank you, sir.
Okay. Any other question? Okay. So again, while I will go through that, the whole idea around bonus, like we did initially, is the fact that the people who issue it who did not pay is free. So we wouldn't have to prorate it. When we are determining the weighted average number of ordinary shares, you don't need to prorate. So you just, irrespective of when it is issued. So when we get to right, we are saying that there is a bonus element in right as well, which we cannot prorate, which was why we separated this. So in determining that, the first thing you do is for you to know the right shares, the right issue. For you to get the bonus element, you need to get what's the new price after issuing the rights. That's the theoretical less right price. And in this case, is 1 for 4. So you just say, okay, we are issuing one for 4 means I'm giving you 1 shares for every 4 that you owed. So to get that, like I did, like I've solved it before. So I did 1 shares that I'm giving you. I'm giving you 1 extra at 1 error for every 4 that you owed. And this every 4 is valued at this market price. Okay, this is my existing market price for your existing shares. So I multiply these two. Then I get the average. So 1 plus 4, 1 plus 6.4, 7.4. And I do 1.4 divided by 5 to give me my TEP. Now, when I get my TEP, I can then determine the bonus element, which is TEP minus right price divided by TEP multiplied by the right issue. So the TEP is 1.48 minus 1 error divided by 1.48 times the right issue. That gives me the bonus element. When I get the bonus element, I can then get the fully paid element by taking it away from the right issue. So as soon as I've separated the right issue into bonus and fully paid, then I can know the one I will prorate and the one I will not prorate. So the outstanding shares is 250,000. The bonus, 2270. I'm not going to prorate that. The fully paid one, I'm going to prorate that based on when they issued the shares. Then I get my right issue of 70 kobo. Now, because of this bonus, I'm going to have to calculate the fact. Let me do basic EPS for 2015. What's my PAT for 2015? 145,000. 145,000. What's my share in issue as at 2015? 250,000. What's my basic EPS in 2015?
8 kobo.
8 kobo.
58 kobo.
Oh, okay.
50.
In addition to that, I will do my adjusted basic EPS because of that bonus, which will be 145,000 divided by the number of shares outstanding plus the bonus, just so that the two are comparable. Bring in the bonus as well. So 145,000 divided by 270, 270. So what does that give us?
54 kobo.
54 kobo. Okay. And that's how right issue works. If you understand this, that's it. It's never going to be more than this. It's like this. It's not beyond this. Any questions? Now the final part is diluted EPS.
Hello, sir. Please, could you scroll up your answer? I'm trying to get the answers just a little bit more. A little bit more, please. Sorry. Okay, it's fine now. I'm trying to. Sorry, please. I'm almost done. Okay. Now, you say you can be scrolling down now. I'm almost there. Adjusted EPS. Sorry. Okay. Okay. Can scroll down now. So thank you, sir.
Okay. So the final part is diluted EPS. And so the whole idea of diluted is the fact that EPS might be impacted by potential ordinary shares. EPS might be impacted by potential ordinary shares. So when you have potential ordinary shares, like convertible instruments, like your convertible bonds, convertible debentures, convertible preference shares, or even your options and warrants, particularly options. Options is when you issue an option. For those of you that did share-based payments, you can give your employee an option, which means that at certain dates, they can buy the company's shares, right? These are potential ordinary shares. So what we want to look at here is the impact of potential ordinary shares on your EPS. So whenever a company has, whenever a company has potential ordinary shares, whenever a company has potential ordinary shares, so whenever a company has potential ordinary shares, it must consider the effect. It must consider the effect of the potential ordinary shares on the basic EPS. So in the sense that if the potential ordinary shares should become ordinary shares, how will it affect the basic EPS? So let's see. We want to see the effect today so that existing shareholders will see that this company has potential ordinary shares. So if they should become ordinary shares, my earnings will reduce by this. So that's diluted. We want to see the impact. That's diluted. Let's use questions to explain that. It's also very straightforward. So if you look at this question, they said in 2016, Mimco had basic EPS of 105 kobo based on the profit for the year of 210 and 200,000 ordinary shares, 200,000 1 naira shares. It also had an issue 40,000, 15% convertible loan stock in 2 years' time at the rate of 49 shares for every 5 naira of stock. The rate of tax is 30%. Calculate the dilutive EPS. So now, they already gave us the basic EPS in 2016, which was calculated based on, if you do 210 divided by 200 shares, I believe that should give us that basic EPS. Okay, yes, it does. So, however, there is a potential ordinary shares here. So it had in issue 40,000, 15% convertible loan stock in 2 years' time at the rate of 49 shares for every 5. So there is a potential ordinary shares. So we need to calculate what will be the impact of these potential ordinary shares on our basic EPS. So there's something we need to do a test for dilution, meaning that we will look at we'll calculate what we call an incremental EPS, right? By doing the interest savings from these convertible instruments divided by the incremental ordinary shares. Now, the interest savings for this interest on the convertible loan stock is 15% times 40,000. Can you give me that?
6,000.
Is 6,000. We're going to deduct tax at 30%, which is 1.8. So the interest savings is how much?
40.
So the idea is this. If this guy should actually convert, this interest I pay, I won't pay it anymore. As soon as it becomes ordinary shares, I won't pay it. So that's the interest savings. That's the only benefit I get from stop paying, from these guys converting. I save interest. I save this interest. So when I save this interest, I put it on the incremental shares, the additional shares I'm going to give for converting, which is I'm going to give 49 shares for every 5 of stock. When I say of stock, that's of the loan stock. Of the loan stock. So that's 4/5 times, what's the value of the loan stock? 40,000. So what are we looking at?
32.
Okay, I'm giving it 32,000 shares. So my incremental EPS is 4,200 divided by the incremental shares, which is 32,000. What's my incremental EPS?
131 kobo. Oh, sorry.
13 kobo.
Thank you.
13 kobo. Now, this is the incremental EPS. So after calculating it, you look at it is when the incremental EPS is lower than the basic EPS. It means that It means that the potential ordinary shares will be dilutive. In this case, our basic is 105 kobo and the incremental is 13. In this case, the convertible loan stock is dilutive. So I can then go ahead. If it's not dilutive, I don't have to compute diluted EPS. It's only when this incremental EPS is lower than your basic. That is when you'd move to the next step of computing this dilutive. Otherwise, you won't. So my dilutive EPS is still my PAT minus preference dividend divided by your weighted average number of ordinary shares. My profit after tax is 210. I will add my interest savings, which is 4,200 divided by the number of ordinary shares plus the incremental shares. Can you give me my final answer straight on?
$92 kobo.
92 kobo. So the basic EPS as diluted, or it will dilute from 105 kobo to 92 kobo as a result of this convertible loan stock. As a result of this convertible loan stock.
Sorry, Brian, it's not clear. We are doing magic in dilutive EPS. So.
I'm not doing any magic, madam.
Oh, sorry, I used that word, sir.
There is nothing.
I was following you, but I was not getting what you were doing, so I was actually following you.
No, you were not distracted.
I wasn't distracted. I'm alone here.
What's the magic here? What is it that you don't understand here? What's special here?
Sorry, I was muted. It's not social. Maybe you could just help me explain it a little bit. I understand. I was following you, but I don't seem to understand it as compared to others.
Yeah, so
Thank you.
again, repeating what I've said before, we need to do a test for dilution. Whenever there is a potential ordinary shares, we need to test the impact on our basic EPS. So in order to know whether it will dilute or not, we need to do an incremental EPS by looking at the savings, the interest savings all upon the incremental EPS. I'm calling it savings because when these guys convert or become ordinary shares, we'll stop paying the interest. We'll stop paying the interest. So how much is the interest we pay per annum? It's 15% on 40,000, which is 6,000. You always remove the tax so that we'll get the net of tax interest. Then the incremental shares is 4 for every 5 of the loan stock, which is 4 over 5 times 40,000. So the incremental shares, when they convert, we are giving them 32,000 shares. So the incremental EPS is 4,200 divided by 32,000, which is 13 kobo. And this 13 kobo is lower than our basic EPS. That means Our test for dilution shows that this potential ordinary shares is dilutive. So if this incremental EPS was such that it was like 120 kobo now, we will not go for that to compute diluted because it will not dilute it. It's not going to dilute it. It won't reduce our EPS. It would even increase it. But since this is dilutive, we went ahead to compute it diluted. It's just the same way, just that now we are saying, okay, well, these guys are converting. So these are our profits. When they convert, we would have an interest savings of 4,200 because we stop paying that interest. Our profit will go up. So if you stop paying this interest, our profit will go up by 4,200. And the weighted average number of shares, we have ordinarily 200,000 shares in issue. When they convert, we'll give them 32,000 shares. So I'm just considering the impact. I'm considering if these guys become ordinary shares, okay, our profit will go up by 4,200. Our shares will issue additional shares of 32,000. So our dilutive EPS becomes 92 kobo, right? So let's solve another one similar to this. This one says Roadco has 7 million shares of 25 kobo each in issue and also had in issue in 2016 1 million 14% convertible loan stock, convertible in 3 years' time at the rate of 2 shares per 10 naira of stock. 2 million 10% convertible loan stock, convertible in 1 year's time at the rate of 3 shares per 5 naira of stock. The total earnings in 2016 were 2.5 million. 2.5 million. So the rate of tax is 30%. Required calculate basic and diluted EPS. Okay. Similar to the last one. So pay attention to this one also. So first is the basic EPS, which is the profit after tax minus preference dividend divided by weighted average number of ordinary shares. And what's my profit after tax? 2.5 million. I don't have any preference dividend as divided by what's the weighted average number of shares? 7 million shares. So what's my basic EPS?
36 kobo.
It's 6 kobo. Now, so they want us to compute diluted EPS as well, but before we compute diluted EPS, we need to do a test for dilution. And there are 2 potential ordinary shares here. There is a 14% convertible loan stock. So to test, we need to do an incremental EPS, which we'll do by doing the interest savings divided by incremental shares. And what's the interest we are paying on this convertible loan stock? Is 14% multiplied by 1 million loan stock, which is how much?
40,000.
40,000.
140,000. We remove the tax at 30%. How much is that?
42,000. 42.
2,000.
42,000. So the interest savings,
98.
98.
so that's the interest savings here. So here, what's the incremental shares? How many shares are we giving? 2 shares per 10 naira of stock. So 2 shares per 10 naira of stock, and this loan stock is 1 million. So what does this give us?
200.
200,000 shares. So my incremental EPF, you said 49 kobo. What did you say? Hello?
Yeah, 49 kobo.
Yes, sir.
Yes.
9 kobo.
Okay. Is this dilutive? Is this dilutive?
Let's go back to the
No,
question.
no, sir.
No.
No, sir. It's not.
No.
Okay. So this is anti-dilutive because the incremental EPS is higher than the basic EPS. So we'll not consider this at all.
Mhm.
The
All right.
second one is the 10% convertible loan stock. So, and this 10% convertible loan stock would also determine the incremental EPS. So to do that, we'll do the interest. What's the interest? That's 10% times what? Times 2 million. How much is that?
200,000.
Okay. We'll do tax at 30%.
60,000.
60. So what are we looking at?
140.
140,000. So what's the incremental shares? So this is the tax savings. Abi, interest savings. What's the incremental shares? What's the conversion? What's the conversion? We are
3
converting
shares
3
to
shares
5 naira. 5 naira
per
of stock.
5 naira stock. So 3/5 times what?
2
3
million.
million.
1.2.
1.2.
That's 1.2 million shares. So you have 1.2 million shares. So what's the
Yes.
incremental EPS?
12 kobo.
That's 140,000 divided by 1.2 million shares. Share 12 kobo, abi?
Yes.
Okay. So is this dilutive?
Yes, please.
Yes. Very dilutive.
Because the incremental EPS is what? Is lower than the basic EPS. Right. So this test of dilution is what would direct us on whether we want to compute dilutive EPS or not. In this case, we would have to compute dilutive EPS by considering only this. Because you don't need to consider this. This will even increase your basic EPS because it's already higher than it. So by the time you compute diluted, but this one that is dilutive, we know that this one will reduce your basic. So let's consider only that. So let's do our dilutive EPS. The formula hasn't changed. PAT preference dividend divided by weighted average number of ordinary shares. So what's the profit after tax? 2.5 million. This dilutive potential ordinary shares
Interest
will start saving how much?
140.
140. What was the number of ordinary shares outstanding? 7 million. Plus the incremental shares. So can you give me my final answer?
32 kobo.
Okay. So our basic EPS diluted from 36 kobo to 32 kobo. Any questions?
Yes, sir.
Okay, Manuel.
So in preparing the normal financial statement in the real world, so when we are having an anti-dilutive APS, it means that we are not supposed to compute the diluted EPS, isn't it?
Yes.
Okay.
Noted.
Any other question?
Hello, sir.
Hello, Farmer.
Good afternoon, sir. Good morning.
Good afternoon. Abi, good
So
morning.
what's the rationale behind this test for dilution?
Okay, I think I already explained that. I said that it's for you to know whether you would compute diluted or not. It's for you to know whether you go ahead and compute diluted EPS or not. So if you have, when you compute your incremental EPS and you see that is lower than your basic, that means that potential ordinary shares is dilutive. Then you can go ahead and compute your dilutive EPS like we did here. The other one that we saw that is anti-dilutive. We didn't bother considering it for dilutive EPS. We just ignored it. So that's what, because if you don't do this, you just go ahead to be computing dilutive EPS. The EPS will not dilute if the potential ordinary shares is not going to reduce if the interest savings is favorable and what is converting to does not really affect anything. So that's the rationale behind it.
Sorry, Mr. Wasu, I want to confirm this plus 140,000. Why is it added?
It's interest savings now. We would not, as soon as these guys becomes ordinary shares, the interest we are paying to them, we will save it. That's the impact of them becoming ordinary shares. We will stop paying this interest.
Okay.
We will not pay this interest again. So it's a savings.
Okay. I'm not deducting it.
No, we will not. Let's solve the last question. Then you can go. It says Remico has the following results for the year ended 31st December 2016. They gave us profit for the year, weighted average number of ordinary shares outstanding, and they also gave us the weighted average number of shares under option and the weighted average number under options and the exercise price for shares under option. We're required to calculate both basic and diluted EPS, okay? So this question is good. The basic EPS is PAT minus preference dividend divided by weighted average number of ordinary shares. For this one, our profit for the year, which is the PAT, is 1.2 million. Our weighted number of ordinary shares outstanding is 500,000. It's 500,000. So what's my basic EPS?
Chikobo for Naira.
How much? Are you saying two and a
Chukobo,
half
yeah.
kobo?
Yes, 2 Naira for Chukobo.
200 and
Okay. Okay, 240 kobo. Now, so the new thing here is this. They gave us the share price of the company as 20 Naira. They told us that the company has an issue. There's an option of 100,000, meaning that some people would have the right, some people has the right to buy our shares in the future. And the exercise price of that option is 15 Naira. See, to keep it simple for yourself, options are always dilutive, eh? I mean, for the most parts, they are always dilutive because we are giving our shares that is worth 20 Naira. We are giving them at 15 Naira. Okay. So for options, the way you should approach it is just for you to calculate what dilutes is the bonus elements of the option shares. The bonus element of the option shares, because they are paying 15 Naira as against 20 Naira for these 100,000 shares we are given. So, I mean, that bonus portion, that additional extra shares they are getting for free will dilute our EPS. So what's the bonus element? Just like we did for right issue, that we do TEP minus right price divided by TEP. In this case, it would be market price minus the option price or the exercise price divided by market price times the option shares. This is similar to how I computed bonus elements for right issue. So in this case, the market price is how much? It's 20 Naira minus 15 Naira divided by 20 naira times what's the option shares? 100,000. So how much is the bonus element of the option shares?
25,000.
5,000.
25,000 shares. So my diluted EPS now
25.
is just the same thing. PHC minus preference dividend divided by weighted average number of ordinary shares. What's the PAT? The profit for the year is 1.2 million. For options, we are not saving anything. So divided by what was the outstanding shares ordinarily? It's 500,000 shares. $500,000 shares plus the bonus elements. So give me my final answer.
229
16
kobo.
kobo.
16 kobo. Diluted. It's too much now. It can't be now.
229 kobo.
Uh-huh.
229 kobo.
229 kobo. And that's my diluted EPS. And this is how you consider options. You see that it's different from the way we did for all these other ones. This is how we consider options. So all we just need to do is for you to understand the fact that options will be dilutive. It will be because we are giving them these shares at 15 naira and is worth 20 naira. So there's a portion of these shares that's free. That would dilute. If they are paid 20 naira, they won't get up to these 100,000 shares. But because we say, yeah, pay 15, that's why they're getting much more. So we need to get the bonus element of that option shares by doing this. Look at the market price minus exercise, because this was free. The differentials here is what's free. So divided by market price times the option shares. So that gives you the bonus element. Then consider it in the denominator. It decreases your EPS. So we call that diluted EPS. And that's all for EPS. So you can try this. This is similar to everything I've done put together. So this one has some convertible option. So test them for dilution and see if it's something you can do. Or do you want us to do it?
Sir, please,
Yes,
I
sir.
have a question.
All right. Chinaya.
Sir, so far we've been computing dilutive EPS. By the time we are done computing, the dilutive amount after we've added the savings or the option savings, it further reduces the basic EPS. But this time around, it actually went from 20 to 220 something.
No, never.
No, 249 is
It
under.
was 240 kobo before. Then it came down to
That's
229 kobo.
Okay, thank you, sir. Sorry, I missed out on that.
Yeah. So guys, try this. Try your hands on this. Of course, before you try it, revise those other ones. And I will advise you, your exam is close. And my student that knows me, I don't finish syllabus. Not I don't, that's not what I don't mean I don't finish syllabus. Is that I don't leave my student until I would continue to revise with you. Also, next week now, I'm going to do a mock revision with you guys. I don't know which one I'm going to do first. Maybe the FR or the SBR. But I'm going to do a revision class for you guys. It will be Saturday, Sunday. one of the days I'm going to revise all the standards. We'll just be revising everything I've taught you, including the one I did not teach you. We'll be revising everything. Then on Sunday, we'll start solving past questions together like that. The same thing for the SBR too. One day I'll just be revising all the standards I've taught you, would be revising it together. Then the next day we'll solve past questions like that. But it's just revision, and it's not even compulsory that you join. And it's assumed that you should have read before you'd, and it's an opportunity that you just for you to refresh, you're supposed to participate and all of that. So, and my approach to all of these things is I know that passing ICAN exam is not about saying, I've completed the syllabus, I've read the syllabus. No, that is not how to pass. Even if you read 70%, there's a way you can look at your past questions and you will know what comes out. Those key things, if you don't read those ones and read them very well, yes, there are certain things that you need to know and know very well. You will pass. There are some things that you can just, okay, this one might come out, might not. Even if it comes out, I can, like for the FR student now, group account, for example, you don't, if you are spending a lot of time on it, you are wrong. You are doing the very wrong thing. No, you don't. You just, you know it, Sha. You know it. That, okay, if it comes out, I have the option of doing it or not doing it like that. So, for, yeah, I would update you guys on a group, but go and attempt this. Go and go and attempt this. Solve this. Don't do it today. If you don't understand it, I can just schedule a 20-minute class, or it's very simple, or a 10-minute class. I'll quickly solve it for you, right? And yeah, I will update you on the next meeting. Just keep reading. Just keep reading. I'm on ground for you guys till you go for your exams. I'm not going to leave you. Continue reading. I would be ready for revisions. And the next thing I want to take is ratio analysis. That's the next thing I want to take. So I'll let you know when that is going to happen. Definitely it's going to happen before the revision class or before the intensive class next week. And some any other things that is necessary, but the revision is going to focus on things that I know that will come out. Things that I know that will come out. So I'll just focus on those ones. For FR, I'll revise those things with you. I'll solve past questions on that with you again. Then you just go. So I'll let you know the class I will have this next weekend and the one I will have the upper weekend. Either one, you are not at any disadvantage. Anyone I choose, it doesn't matter at all. Because this is something you're supposed to take to the exam. You're supposed to remember it to the exam like that, right? Just so that nobody fails. Okay, so I'll see you guys later. My case study student, remember, would finalize our analysis this evening on Spicy. Thank you very much. Have a wonderful Sunday.
This question,
See you.
sorry, sir. Before you go, sir, what are you required to do? EPS or consideration required?
Basic and diluted.
Okay. Thank you, sir. Thank you so much for the class, sir.
You're
Bless
welcome.
you.
I'll share these materials immediately with you. Bye.
Right, sir. Thank you very
Thank
much.
you, sir.